This chart shows a standard investment portfolio growing over 30 years. It starts flat, but climbs aggressively toward $300,000. That steep upward bend is compounding. Your money earns a return, and eventually that return earns returns of its own. Today, we are going to build a personalized 4-step checklist to set up that exact mathematical engine for your family. Before we look at the first rule, grab a pen and paper. Think of a dollar amount you can comfortably set aside every month. Even if it is just $100, write that target number down. Having a concrete written plan takes compounding from an abstract mathematical concept and turns it into a mechanism that actually builds generational wealth. Step 1. At the top of your paper, write down your target monthly amount, along with the year you plan to retire or use the funds. The exact dollar amount you chose matters less than your timeline. Investing is identical to planting a tree. A seed planted 30 years ago has a massive advantage over a seed planted today, simply because it had time to establish deep roots. A teenager who starts putting away just $100 a month at age 18 will easily outpace someone who waits until their 40s and tries to catch up by investing thousands at a time. Getting your money into the market today is far more effective than sitting on the sidelines, waiting until you have a perfect large lump sum to invest. Step 2. On your checklist, write down the phrase automate monthly plan. This strategy is called dollar cost averaging. It means you commit to buying the exact same dollar amount of investments on the exact same day of every single month. Many people try to predict the market. They wait for the lowest point to buy or try to sell right before a drop. Statistically, retail investors fail at this timing, missing the best recovery days and cutting their long-term returns in half. Instead of trying to push your investments up and down volatile, unpredictable spikes, automation gives you a smooth, downward roll. You accumulate shares consistently, absorbing the highs and lows over the decades. Automation removes human emotion from the equation. It turns investing into a background process, rather than a stressful daily decision. For step 3, write down this rule. Turn on dividend reinvestment. Many index funds and companies distribute a portion of their quarterly profits directly back to their shareholders. This cash payout is called a dividend. You have a choice when that cash hits your account. You can withdraw it, or you can check a setting in your brokerage that automatically uses that cash to purchase additional fractional shares of the fund. This chart illustrates the difference between those two choices over a 30-year timeline. The bottom line tracks a portfolio where the profits are cashed out. But when you use those dividends to buy more shares, the top line begins to radically pull away. Reinvesting your dividends creates a tight feedback loop. Your larger share count generates higher payouts next quarter, which buys even more shares, triggering the explosive upward phase of your portfolio. Step 4 is a psychological rule. Write down, "I will buy more, not panic," during a crash. The most common point of failure happens when global events trigger intense market fear. Watching severe declines across the boards prompts many investors to sell everything, locking in massive, permanent losses. But if you maintain the automated system we built in Step 2, you do exactly the opposite. Your account automatically continues buying shares, except now those assets are priced at a steep discount. As this headline from the Great Crash of 2008 shows, deep downturns are historical realities. But so are the economic recovery cycles that follow, which consistently reward those who hold through the fear. A recession is not a wealth-destroying event. For a patient, automated investor, a market downturn is the most lucrative buying opportunity they will experience. Look at the paper in front of you. You now have a comprehensive, personalized strategy to build long-term wealth. You are no longer trying to guess what the market will do tomorrow. You have moved from a passive observer to an active systems builder. Your final step happens right now. Log into your brokerage account today, set up your recurring monthly transfer, and double-check your account settings to verify your dividend reinvestment is toggled to on. True wealth is rarely built by outsmarting the market on a given day. It is built by setting up an emotionless system, staying consistent, and letting time do the heavy lifting for decades.